Alright everybody, Marco Palmiero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced and negotiated in the past, we break them down, we analyze them, we find lessons that we can take away from them, but also mistakes that we've made that can help us execute better deals in the future here in the UAE and in the Middle East. As always, we focus on our proprietary deal flow at Ulysses, and these videos are focused on helping leaders, entrepreneurs, and investors looking to buy assets in the United Arab Emirates and in the Middle East. Hopefully, some of the mistakes that we have made and some of the information I'm going to share can help you avoiding, painful mistakes and can save you some time, money, and resources in the process. So, in today's deal, I want to talk with you about an important concept, which is the idea of focusing on off-market deal flow. This deal made me realize the importance of targeting off-market opportunities here in the Middle East. And I will tell you the reasons in a second. Now, if you have watched other videos on this channel, you already know that I stress the idea of finding off-market deals when looking at businesses that you want to buy in the United Arab Emirates or in the Middle East. And in this case, I'm going to share with you why I started to feel that way and how that process helped us sourcing better targets, as we evolved our strategy and adapted to the situation. So before we do that, a little bit of background on the deal. We were talking about a business that was very, very old, 40-year-old business. So it was a well-known, established operation in the UAE. And it was operating in three separate locations. The staff was around 40 people, and it was split not evenly between the three locations. So there was one main location that was employing about 25 people. The other two were employing about 7 people. So we're talking, again, about a main hub for the business and 2 branches, so to speak. There was no real estate involved. It was a plain business transaction. And the motivation for selling was that the owner wanted to relocate back to his home country and start a business there. So it was transitioning out of the United Arab Emirates, which is something that is very common here. And if you watched other videos, you probably know a little bit about that. Now, that was the perfect scenario for us. And the revenue also confirmed our positive outlook to the deal, right? We had a business that was generating about $4 million a year in revenue and about $1 million in EBITDA. So everything looked fine. The business looked solid. It was a well-established operation, known brand in the market. Staff was okay, and the business was already independent of the owner. So the guy was not coming in to do anything, and that was a very good sign for us because we could easily transition it under our own management without having to worry about management problems. So all considered, the deal looked quite good on paper. Now, how did we find this deal so that you have a little bit of context around this? We found it through an online listing. So my team found the deal through an online listing. And so as we started the negotiation, we asked the guy if he was entertaining other offers, because of course, if you have a listing online, chances are a lot of people are going to reach out to you. He said he was considering other offers, but he never really had an idea to sell to these guys. So we said, okay, let's see if we can put down some price terms and offers and then create a binding offer that can tie us up to this person for the due diligence phase. So we started the soft due diligence and kind of like initial checks to make sure we can submit a offer to him. And at that time, what happened was that the person was traveling back and forth from his home country because he was taking care of this transition. So he had family that he needed to transition, a new business over there that he needed to start. And so he was going back and forth. And that kind of like broke down the process and the interaction between the two of us. We didn't have the ability to continuously talk to him, even though we could call him and we were calling him. It was not the same as talking to him one-on-one, in a room. So what happened was the process got stretched a bit more than I ideally wanted. And that's when problems started to happen, because as the deal was getting stretched, it meant that fundamentally more people had the opportunity to see the listing online and contact this guy. And so the longer it took us to put down a binding offer, the more time we were giving to potential competitors to find this deal and steal it from us. Fundamentally, that's exactly what happened. So during these travels, the guy was of course taking inquiries from people, and one day he called us back from his home country and he told us, well, I just received an offer for the business, right? It is close to the price that I'm asking for, and it is 100% cash. What he said to us was that some wealthy investors, a group of investors, had come together and decided to make that offer to him, and he was willing to take it. And so fundamentally, there was little that we could do about it at that point, because we were in the process of adjusting and raising financing. That was almost done. It would have probably taken us about 7-10 days more. And then there was the due diligence phase. So we were a bit late compared to these guys making the offer, and there was little that we could do about it. So what we said to him is, listen, we're willing to honor our commitment and continue the process as we decided. If you're willing to wait that 7-10 days when we have confirmation for the financing and initial term sheet, then we can put down a binding offer, start the due diligence phase, and potentially get the deal done in 4 to 6 weeks. The guy didn't see that as an option, and he would rather stick to these guys who promised them 100% cash up front and a quick close. And I can't blame him, honestly. I don't know if that deal ultimately closed, because I didn't speak to him afterwards. But certainly it makes sense for him to go with somebody who who's open to pay 100% cash up front and do it fairly quickly. Now, that isn't something that happens often in the region. Based on my experience, people are very resistant to pay 100% for a business, and they always want to have some sort of deferred consideration, earn out, or stuff like that. But that was one of the rare scenarios where the guy hit the jackpot, right? Now, let's talk about the takeaway and what I've learned from this process. Well, fundamentally, what I took away from this was that despite the deal being good, I still got involved into this deal because we found the transaction on the site. It was a listing. And that kind of made me think, well, if anybody can step into this deal and fuck up with our process at any point in time, wouldn't it be better for us to just focus on deals that are not listed on sites, so that we can actually have preferential access to the transaction and avoid a lot of people submitting bids, so that they can potentially influence the decision of the owner, even if the deal didn't end up closing. And so I started thinking about this way, and I progressively realized that off-market was the way to go, despite being harder and more time consuming than just browsing sites and talking with people in the industry. And I think some of the challenges that we have faced before, we didn't really stumble across after we started sourcing off-market deals, because one of the problems that many people have when they work on deals that are listed on sites or they're provided by investment bankers and stuff like that is that there's going to be a pool of buyers working on that deal. Many of them are going to submit offers, bids, they're going to work on the deal, and there's going to be little ability for one single buyer to control the transaction unless you get to a point where you can make a binding offer and you can dictate you can dictate to the other party, you're not going to talk with anybody else. Based on my experience, that is not a reassurance that the other person is not going to close the deal with somebody else. Only because they sign a binding agreement, that doesn't mean the deal is going to close with you. They might still drag you along, then say no, and 2 days after close with somebody else. But the point is, working with deals that are heavily competitive wasn't really the way to go, especially because of the structure that we had. So our acquisition criteria, and I'm assuming yours too if you're watching this video, are focused on reducing our risk. And as a consequence, we are not really open to pay 100% cash for a business. It's not something that we do in any circumstance, no matter how good the deal is. So that creates situations where we either need to have some sort of deferred payment structure, or we need to raise capital externally, either debt or other sources. That, of course, stretches the timeline a little bit. And that window of time leaves an opening for other people to potentially put in their offer. And even if that offer is not something that they're willing to follow up on, and that they're willing to pull the trigger on, the seller doesn't know it. And so he might still be attracted. It may still be lured in an offer that seems very good, but then the guy might not close the deal, might not proceed with that. The problem is we get affected by it because the seller doesn't know how buyers submit bids and how committed they are in closing a transaction. And if he ultimately gets influenced by this continuous bidding, you're going to get affected as a consequence. So you're not going to be able to have a streamlined deal and a streamlined process for executing the transaction. So for me, that was a huge problem, and I didn't want to get involved with these types of issues anymore. So I started thinking with my team and my partners, how do we source deals that are not competitive? And the idea was, okay, let's focus on off-market opportunities, which is something that nobody's willing to target, right? And the reason is quite simple, because it takes a lot of effort. It's manual labor, literally. So you gotta call these guys, email these guys, go see places, do network, leverage your existing network and build it accordingly so that people can refer you deals. All these processes and procedures take time, money, and also mental energy. And most people across the industry aren't willing to do that work, especially in small business deals, because it simply doesn't make sense for them economically, So we said, okay, let's do what most people aren't willing to do, and let's see how that plays out. And true to be said, it worked perfectly well. And it actually showed us that off-market deals were the better way to go about acquisitions in this particular region. And the reason for that is simple. We found out that many small business owners might be interested in selling the business, but they don't have the courage or the will to put the business on a site, put the business through an investment banker, find an advisor that's going to list the business for them, because they want to keep the sale confidential. There's a lot of reputation that gets involved when you're trying to sell the business, and some people still see that as sort of like a stigma, and that's just the way it is. So they don't want necessarily a lot of people to know that they're exiting their business. Plus, they don't want the staff to be affected. They don't want word to spread. And when we talk about UAE, we're talking about a very small market. So after some time, if you put out a news that you're selling the business, everybody's going to know about it. And so a lot of people don't want to go down that avenue, and they decide, okay, I would be interested in selling it, but I would only consider that after I know a guy is serious, or after I been approached by somebody, and when I know I can keep that sale confidential. And the only way to find out these opportunities is really talk to a lot of people, talk to a lot of sellers, or be introduced to the sellers by people that are actually trustworthy. And that is really off-market deals. So it's effort that you need to put in to find these premium gems, these good opportunities that then are going to be much more interested in following up with the process, because they're not interested in letting other people know that they're selling. So not only less people are going to know about the deal, but the seller is going to be more invested in the process, because once he decides to go forward with you, he doesn't want anybody else to know, because otherwise the word will spread. And so as I started sourcing these deals off market, and we saw also the good performance of some of these deals, we realized that was the way to go about finding deals here. Because in some cases we realized that a lot of off-market deals were much better from a financial perspective than the one listed on sites. Because of course, if you list something on a site, the best opportunities are going to sell quickly. A lot of people are going to be interested in it, a lot of bids, business going to get sold quickly. All the businesses that are left are something that nobody wants to touch, really. And if you see a business that has been listed for 6, 9, 12 months, something is not right with that asset. And there's an interesting trick that people use, and I'm not sure if you're familiar with it, but I'm going to share it anyway. On some broker sites or sites where you can find businesses, you will find out that people take out a business after a couple months and they relist it as new, just to show people that it is fresh, while instead it had been on the market for probably 12, 14 months. So they use this tactic of, listing it, leaving it for 3-4 months. If it doesn't sell, they take it off, they relist it, so it looks like as a new listing, but in reality it is old, and they're trying to play with the system a little bit to show the business as more attractive than it actually is. Long story short, lesson that I took away is that off-market deals are the way to go. Better opportunity, less competitive. Once you've built the network, people will come to you only, and you have preferential access to assets that might be very, very good. And again, it takes a lot of time. I mean, it took us between 24 and 36 months to build that system correctly, because it's not just something that you can automate. Really, it's a lot of connections, network, and interpersonal relationships that you also have to build. So it took us some time, but provided you're willing to go down that avenue and do all that work, you're going to have access to superb opportunities. You need to commit capital, effort, and staff into this process. But provided you're willing to do that, there's no limit to the opportunities that you can find in the region. Now, if you don't want to do that because you have a time constraint on your process and you want to execute deals in a short period of time, you can consider working with someone like us. So we already have built that system. We just need to plug in the niche or the industry that you're targeting, and then start sourcing deal for you, and you just collect the results. So fundamentally, you're skipping the 24 or 36 month process that is needed to build that pipeline and that deal flow, and you're getting access to the premium opportunities right away. Again, the choice is up to you, but my take and my perspective on the region is that off-market deals are the way to go. They're really the best way to tap into good opportunities, negotiate them from a position of strength, and also avoid, people stealing deals from you. So hopefully that resonates with you a bit. It applies for United Arab Emirates, but also to other countries in the Middle East, because we had the same experience in Saudi Arabia, in Oman, and other places. So that applies for the entire Middle East. And hopefully this resonates with you, and I will see you in the next episode.